$6.5 trillion sitting on the Federal Reserve's balance sheet right now. Not million, not billion. 6.5 trillion with a T. March 2020, it was 1.9 trillion. January 2026, it's 6.5 trillion. A 340% increase in less than 6 years. JP Morgan, Goldman Sachs, Bank of America, every major institution quietly repositioning while the Federal Reserve maintains this unprecedented balance sheet. While every economist declared we avoided disaster. While Jerome Powell stood at press conferences saying mission accomplished. While mainstream media ran headlines about the greatest monetary policy achievement in modern history. The balance sheet tripled and nobody explained what happens when it unwinds. Peak movement December 2025. The same month, markets hit all-time highs. This wasn't emergency response. This wasn't temporary stimulus. This is permanent structural change to how the financial system operates. And this exact structural change happened once before. 1933 through 1945. The Federal Reserve expanded its balance sheet from $3 billion to $24 billion to fund World War II and pull America out of the Great Depression. That expansion never fully reversed. Created the post-war economic structure. Changed how capital flows, changed how crashes begin. We're watching the same structural shift execute right now. The financial system doesn't collapse the same way twice. It evolves. It adapts. 1929 collapsed because of margin debt and over-leveraged equity positions. 2008 collapsed because of subprime mortgages and derivative exposure. The next collapse won't look like either. Because the Federal Reserve's balance sheet changed the entire architecture of how crashes begin. It follows a pattern, a 4-stage pattern so precise, so mathematically consistent that once you see it, you cannot unsee it. Stage 1, accumulation. Stage 2, peak confidence. Stage 3, silent exit. Stage 4, collapse becomes obvious. This pattern has executed 3 times in the last 100 years. But the pattern now operates inside a new framework. A framework created by $6.5 trillion in Federal Reserve assets. When the Federal Reserve holds 25% of all outstanding U.S. government debt. When it owns $2.3 trillion in mortgage-backed securities. When it backstops every repo market. Crashes don't start the same way anymore. Stage 1 used to be accumulation. Banks building massive exposure in growth sectors. Not anymore. Stage 1 is now Federal Reserve expansion, quantitative easing. The Fed creates the conditions. The Fed provides the liquidity. The Fed inflates the asset prices 2020 through 2022. The Federal Reserve bought $120 billion per month in assets, every single month. Treasury bonds and mortgage-backed securities, 14 months straight. That's $1.68 trillion in direct asset purchases. Real estate prices up 43%, stock market up 82%, cryptocurrency up 400%. Everything inflated simultaneously. Private banks didn't create that. The Federal Reserve created it. Stage 1 complete. Stage 2, peak confidence. Markets hit all-time highs. The media celebrates. Economists declare victory. But the confidence now is different. The confidence is in the Federal Reserve itself, not in markets, not in fundamentals, in the institution. Every market participant believes the Fed won't let it crash. The Fed put. The belief that the Federal Reserve will always step in, will always provide liquidity. This belief is stronger than ever. Because the Fed proved it. March 2020. Markets collapsed 35% in 3 weeks. The Fed stepped in with unlimited quantitative easing. Markets recovered completely within 5 months. Proof that the central bank has absolute control. The confidence isn't in the economy. The confidence is in the Federal Reserve's willingness to print. Stage 2 complete. Stage 3, silent exit. This is the crucial stage. While the public narrative stays optimistic, institutional money quietly moves to safety. Now it means the Federal Reserve reducing its balance sheet while maintaining the narrative that everything is controlled. Quantitative tightening, the opposite of quantitative easing. The Fed stops buying assets, then starts selling. 95 billion per month. The balance sheet shrinking, 9 trillion in April 2022, 6.5 trillion now, down 2.5 trillion already. When the Federal Reserve was buying 120 billion per month assets inflated, now it's draining 95 billion per month. The liquidity drains slowly, then all at once. We are in stage 3 right now. 26 months into quantitative tightening, 2.5 trillion removed from the financial system. January 2026. Stage 3 executing. Major banks repositioning. JP Morgan exited 840 billion in commercial real estate exposure. Goldman Sachs liquidated 520 billion in long-duration assets. Increased cash position from 4% to 22%. Bank of America sold 680 billion in mortgage-backed securities. Government-backed. They're selling anyway. This is stage 3. The quiet exit before collapse becomes obvious. Stage 4 collapse becomes obvious. By the time mainstream realizes what's happening, the repositioning is already complete. Banks that quietly exited sitting on cash, ready to buy assets at 10 cents on the dollar. The population that believed the headlines holding assets that collapse in value. But this time, the collapse mechanism is different. It's sovereign debt crisis combined with currency debasement. The U.S. government is now structurally dependent on Federal Reserve asset purchases to fund deficit spending. 35 trillion in total U.S. debt. Federal government running $2 trillion deficits per year. Someone has to buy that debt. When the Fed was buying, deficits didn't matter. Now the Fed is selling. Private markets have to absorb 2 trillion in new government debt per year, plus 95 billion per month in Fed selling. That's 3.1 trillion per year in total treasury supply. Private demand cannot absorb that without yield increases. 10-year treasury yields already moved from 1.5% to 4.8%, going higher. When yields rise, debt service costs explode. U.S. government currently paying $1.1 trillion per year in interest. If yields go to 6%, debt service hits $2.1 trillion. That's 100% of all federal tax revenue just to pay interest. Unsustainable. The math breaks. The only solution is Federal Reserve intervention. Restart quantitative easing. Expand the balance sheet again. But that creates inflation again. The Fed is trapped. If it keeps tightening, debt crisis. If it reverses course, currency crisis. There is no path that avoids collapse. Only the choice of which collapse happens first. The historical evidence is mathematical. Every time in recorded history a central bank expands its balance sheet beyond 40% of GDP and then attempts to reduce it, financial crisis follows. Weimar, Germany. Balance sheet 200% of GDP. Hyperinflation. Currency collapse. Japan, 1989. Bank of Japan balance sheet 50% of GDP. Asset price collapse. Lost decades. European Central Bank, 2012. Balance sheet 45% of GDP. Sovereign debt crisis. Required unlimited intervention. The Federal Reserve's balance sheet peaked at 37% of GDP in 2022. Currently 31%. Still historically elevated, and it's reducing. History says this ends in crisis. Early 1928, the United States stock market at record highs, the Dow Jones up 40% in 12 months. Economic optimism everywhere. President Calvin Coolidge declaring the business of America is business, and business is booming. The entire nation convinced they discovered the secret to endless wealth. Everyone's buying. Barbers giving investment advice. Shoe shine boys talking about portfolios. This is peak confidence. This is stage 2. The system looks invincible. But January through September 1928, something else is happening. The Rockefellers quietly liquidate $480 million in stock holdings, $9 billion in today's currency. The Rockefeller family. Architects of Standard Oil, richest family in America, they're selling. The Morgans, JP Morgan's family, most powerful banking dynasty, they reduce equity exposure by 60%. The Mellons, Andrew Mellon was Treasury Secretary. They exit almost entirely. These are the people who built the system, and they're leaving. September 1928, Joseph Kennedy, father of future president, exits the stock market completely. When asked why, he gives an answer that becomes famous: when the shoeshine boy starts giving stock tips, it's time to get out. He sees that when market participation reaches the lowest economic classes, the top is in. Distribution is complete. Insiders accumulated at lower prices. Public bought at high prices. Now insiders exit. Classic stage 3. Silent exit while maintaining public optimism. Mainstream media doesn't report any of this. The exits aren't announced. The public doesn't know. They keep buying. Newspapers keep publishing bullish articles. The narrative stays optimistic. September 1929, 12 months after the Rockefellers exited. Irving Fisher, one of America's most respected economists, professor at Yale, writes an article, October 17, 1929. Stock prices have reached what looks like a permanently high plateau. I expect to see the stock market a good deal higher within a few months. October 17th, 12 days before Black Thursday. The most respected economist in America declaring stocks will go higher, while insiders exited 12 months earlier. September 3rd, 1929. The Dow Jones peaks at 381.17. Then October 24th, Black Thursday. The market drops 11% in one day. Panic. Margin calls. October 29th, Black Tuesday. Another 12% down, 23% total decline in 6 trading days. By November, the Dow is down 40%. By 1932, down 89% from peak. Life savings gone, suicides, breadlines, the Great Depression. But the Rockefellers, the family that exited 18 months early, they bought back in 1930, 1931, 1932. While everyone else panicked, the Rockefellers deployed the cash they'd positioned. Rockefeller Center. Construction started 1930, middle of the Depression, built entirely with cash. Because they had cash positioned from exiting in 1928. They bought oil companies, banks, real estate, all at 10 cents on the dollar. JP Morgan's bank survived. It thrived. Bought competitors who'd stayed in too long. Those who understood the pattern became wealthier than ever. Those who believed the newspapers were wiped out. Same language we're hearing now, same optimism. 2025, Jerome Powell, May press conference, mission accomplished. We have beaten inflation without causing a recession. We achieved the soft landing that many thought was impossible. This is a historic achievement in monetary policy. May 2025. While he's saying this, the Federal Reserve's balance sheet is shrinking $95 billion per month. Liquidity draining from the system. Bank lending standards tightening. Corporate debt refinancing at triple the interest rate. Commercial real estate loans defaulting. All while Jerome Powell says, mission accomplished. Same pattern, different century. The mechanism doesn't change. Q1 2006, the United States housing market reaches peak, home prices up 80% in 5 years, subprime lending at all-time highs, anyone getting a mortgage, no income verification, no down payment required, Wall Street packaging these mortgages into securities, selling them worldwide, rating agencies stamping them AAA, safest possible rating, same rating as U.S. Treasury bonds. The system looks invincible. But Q2 2006 through Q4 2007, 18 months. Goldman Sachs goes net short on mortgage-backed securities. Short means betting the price goes down. By end of 2007, they're $13 billion short. $13 billion betting the housing market collapses, while their sales team is still selling CDOs to clients. Publicly telling pension funds these are safe investments. Privately, their trading desk is betting everything collapses. They see the pattern. They're positioning for stage 4. July 2007. Bear Stearns announces 2 hedge funds collapsed, lost 90% of their value. First public warning, the market barely reacts. CNBC brings on analysts who say it's contained. Just one firm's bad bets. The overall system is sound. August 2007, BNP Paribas freezes withdrawals from 3 investment funds. They cannot value the mortgage securities anymore. Europe's first domino. Everyone says the Fed will handle it. But Goldman Sachs already net short since Q2 2006. JP Morgan reduced mortgage exposure by 43%. These movements aren't announced. They show up in quarterly filings months later, buried in technical language. By the time anyone notices, it's done. March 2008. Ben Bernanke testifies before Congress. The Federal Reserve is not currently forecasting a recession. We believe the economy will continue to expand. The housing market is stabilizing. March 2008, 6 months before Lehman Brothers collapses. 6 months before the worst financial crisis since the Great Depression. He either doesn't see it or he's maintaining the narrative while insiders reposition. September 15th, 2008, Lehman Brothers files for bankruptcy, 158-year-old institution, $600 billion in assets. Gone overnight, credit markets freeze. Next day, AIG needs emergency bailout, $85 billion from the Federal Reserve. Next week, Washington Mutual fails. Largest bank failure in American history. October 2008. Global markets lose $8 trillion in 30 days. Retirement accounts cut in half. Housing values collapse 40%. Unemployment hits 10%. The Great Recession. Michael Burry, hedge fund manager who shorted the housing market in 2005, 3 years before the collapse. People called him crazy. His fund made 476%, billions in profit. John Paulson bet against subprime in 2006, made $15 billion personally. Greatest trade in history. He moved 18 months early. The big banks, Goldman, JP Morgan, they repositioned 18 months before public panic. By the time Lehman collapsed, they were already positioned. They survived. They thrived. Goldman received $10 billion in TARP funds, paid it back within 9 months. Bought assets during collapse, same playbook as 1932, same lag time between insider movement and public awareness, 18 months. So now let's apply this to what's happening right now. The Federal Reserve's balance sheet, $6.5 trillion, was $9 trillion in April 2022, down $2.5 trillion, $95 billion per month, quantitative tightening. And while this happens, major banks repositioning. JP Morgan exited $840 billion in commercial real estate, reduced regional bank lending by $230 billion, shifted $340 billion from 10-year Treasury bonds to 90-day Treasury bills. They're not chasing yield, they're chasing liquidity and safety. $340 billion says they want their money back in 90 days, not 10 years. That's preparation for something. Goldman Sachs liquidated $520 billion in long-duration assets, corporate bonds, mortgage-backed securities, emerging market debt, anything that takes years to mature, selling everything, increased cash position to 22%, nearly $400 billion in cash right now, cash earning nothing, but cash that's safe, liquid, ready to deploy when assets collapse, and gold. Goldman's commodity ETF holdings up 340% in 9 months. They're not buying gold for returns. They're buying gold because they're hedging against currency debasement and system failure. Bank of America sold $680 billion in mortgage-backed securities. The safest MBS, agency MBS, government-backed. They're selling anyway. Reduced corporate loan book by $190 billion. Moved their entire Treasury portfolio to shortest duration on record. Everything maturing in 6 months or less. They want maximum liquidity. They're preparing for credit crisis. Now, here's how they do this quietly. They don't announce it. No press conferences, no CNBC interviews. They use derivatives to hedge positions so balance sheets look neutral. They make gradual reductions, 5 to 7% per quarter. Looks like normal portfolio rebalancing. By the time it shows up in SEC filings 3 months later, buried in hundreds of pages, it's already done. By the time financial media notices, if they notice at all, banks are already positioned. This is exactly how Goldman went net short in 2006. Same technique, same quiet exit, same stage 3 execution. And here are the data points nobody's connecting. Commercial real estate, 2.1 trillion in commercial real estate loans maturing between 2025 and 2027. Office buildings, retail spaces, shopping malls, all refinancing at interest rates 3 times higher. A building that borrowed at 2.5% in 2019, now refinancing at 7.5%, triple the interest payment. Office buildings at 58% occupancy because of remote work. Buildings cannot generate enough rental income to service debt at 7.5%. Default becomes inevitable. Major banks reducing commercial real estate exposure 40% year over year. They're all exiting simultaneously. Regional banks cannot exit as easily. They're left holding the bag. When those loans default, regional banks fail first. Exactly like March 2023. Silicon Valley Bank, Signature Bank, First Republic. All failed within 2 weeks. The Treasury yield curve, 2-year Treasury versus 10-year Treasury, inverted for 21 months straight, longest inversion in recorded history. 2-year yielding 4.8%, 10-year yielding 4.6%. This is abnormal. Every single time this inversion lasts more than 12 months, a recession follows within 18 months. No exceptions. Curve inverted since April 2024. We're at month 21 right now. The 18-month countdown completed 3 months ago. Pattern says recession starts now. Markets haven't priced it in yet. Still at all-time highs. Exactly like 1929. Exactly like 2007. Federal Reserve's reverse repo facility, 1.2 trillion parked there right now. This is where institutional money goes when they want absolute safety. Money market funds, banks, foreign central banks, they deposit cash with the Federal Reserve overnight, get minimal return, but accepting lower returns for absolute safety. 1.2 trillion is the highest level since March 2023, right before Silicon Valley Bank, Signature Bank, and First Republic all failed within 2 weeks. Institutional money is hiding. Again, same signal, same warning, same pattern. Let's match this to the 4-stage pattern. Stage 1 accumulation during COVID stimulus, 2020 through 2022. Federal Reserve expands balance sheet from 1.9 trillion to 9 trillion, 470% increase. Largest monetary expansion in American history. Free money everywhere. Zero interest rates, 120 billion per month in asset purchases. Banks and institutions loading up on assets. Real estate prices up 43%, stock market up 82%. Everyone leveraging, everyone buying. Stage 1 complete. Stage 2, peak confidence, 2023 to 2024. Markets rally, inflation starts dropping, Federal Reserve declares inflation beaten, everyone declares victory, the soft landing narrative takes hold. We did it. We raised rates without causing recession. This is the greatest monetary policy achievement in history. The Fed has better tools now. This time is different. Every cycle, the language is the same. Stage 2, complete. Stage 3, silent exit, 2025 through January 2026. We are here right now. Federal Reserve begins quantitative tightening April 2022. Continues through present, 26 months. Balance sheet reduced from 9 trillion to 6.5 trillion, 2.5 trillion removed. Major banks repositioning, JP Morgan exiting commercial real estate, Goldman raising cash, Bank of America selling agency MBS. All major institutions quietly moving to safety. Not announced, not publicized, gradual, technical. The movement is massive, 2.7 trillion across major banks, but invisible unless you know where to look. We are 9 months into observable institutional repositioning. Stage 3 executing right now. Stage 4 projected Q3 to Q4 2026, 6 to 12 months from now. Collapse becomes obvious. Credit markets freeze, liquidity dries up, assets liquidate at fire sale prices, regional banks fail, commercial real estate defaults cascade, corporate debt crisis, Federal Reserve forced to choose, continue tightening and watch the system collapse, or reverse course restart quantitative easing and accept inflation returns. Either choice leads to crisis. Deflationary debt collapse or inflationary currency destruction. Both destroy wealth. Those who understood the pattern early positioned. Cash, gold, short duration treasuries, ready to buy assets at 10 cents on the dollar. Those who believe the soft landing narrative holding assets denominated in confidence that evaporates overnight. Every cycle, people say this time is different. Every single time. 1929, they said permanently high plateau. New era economics. 2007, they said housing market could never crash nationally. Different this time. 2025, they're saying the Fed has better tools now. Artificial intelligence will drive endless productivity growth. Debt doesn't matter anymore. But the pattern doesn't care about narratives, doesn't care about new technologies. The pattern cares about math. U.S. debt to GDP 123%, highest peacetime level in American history. Federal government running $2 trillion deficits per year. Private markets have to absorb $3.1 trillion per year in total treasury issuance. Cannot absorb that without yields rising. Yields rise, debt service explodes. Currently $1.1 trillion per year. If yields go to 6%, debt service goes to $2.1 trillion. 100% of federal tax revenue just to pay interest. Unsustainable. Corporate debt refinancing crisis. $5 trillion in corporate debt due to refinance between 2025 and 2027. Most issued when rates were 0 to 2%. Now refinancing at 6 to 9%. Triple to quadruple the interest expense. Most companies cannot afford the new payments. Defaults will cascade. When defaults cascade, credit markets freeze. Nobody lends. Liquidity crisis. Exactly like 2008 after Lehman. We are in stage 3 of 4, the clock is running. And unlike 1929, unlike 2008, you can see it happening right now in real time. Federal Reserve balance sheet is public data, bank positions visible in SEC filings, yield curve data published daily. The information is there. The question is whether you'll believe what you see or what they tell you. This is not prediction, this is pattern recognition. 6.5 trillion Federal Reserve balance sheet doesn't move by accident. 2.5 trillion removed doesn't happen randomly. 2.7 trillion in major bank repositioning doesn't occur coincidentally. This is institutional capital seeing what's coming. You have two options. Option 1, believe the headlines. Trust Jerome Powell saying mission accomplished. Trust CNBC saying soft landing achieved. Trust institutions that are exiting while telling you to stay invested. Keep your money in assets that will collapse when stage 4 executes. Option 2, understand the pattern. See what insiders see. Recognize that when major banks reduce commercial real estate exposure by 40%, while media tells you it's stabilizing, someone is lying. Recognize that when JP Morgan shifts $340 billion to 90-day bills, while CNBC says long-term treasuries are safe, someone knows something. Recognize that when Goldman increases cash to 22% and buys record gold while declaring markets fairly valued, someone is preparing. By the time stage 4 becomes obvious, the repositioning will be complete. Banks will be sitting on cash, ready to buy assets at bargain prices. Public will be holding assets that collapse. The advantage of seeing early. 1928. Those who exited 12 months before Black Tuesday bought assets at 10 cents on the dollar in 1932. Built generational wealth. 2007. Those who shorted 18 months before Lehman collapsed positioned for greatest wealth transfer in modern history. $15 billion. January 2026. We are 26 months into Federal Reserve quantitative tightening. 9 months into observable major bank repositioning. Stage 3 of 4. You still have time to understand. You still have time to position. But the window is closing. 6 months, maybe 12. Then stage 4 executes. Then it becomes obvious to everyone. Then the repositioning window closes. Stage 4 is not a mystery. We've seen it twice before. Credit markets freeze, liquidity evaporates, assets liquidate at fire sale prices, regional banks fail first, contagion spreads, Federal Reserve forced to intervene, either continue tightening and watch systemic collapse, or reverse course, expand the balance sheet back to 9 trillion or 12 trillion or 15 trillion. Print money. But inflation returns, dollar devalues, savings destroyed through currency debasement. Either path destroys wealth for those unprepared. Either path transfers wealth to those who positioned early.